Well, hello there, my friends. Chris Marchese here with you for Arcadia Economics on Friday, July 2nd, ahead of the July 4th weekend. So hope everybody's having a lovely morning out there so far. Silver price actually up a little bit, hopefully going to help walk a few people off the ledge and to continue with that therapy. I know it's been a challenging week for many silver investors. So I brought out the big guns. And as you can see on the bottom right, there's Dave Kranzler. Look at the focus. He doesn't even want to hear my intro because he's that keen. He wants to know the curve of each tick on the silver chart. You can see him looking at it there. Dave, I admire the passion. Thanks for bringing it as always. Welcome on in, sir.
Thanks for having me. And I am listening.
Okay, well, I thought that was a pretty smooth intro.
I can dual task.
That one or you can hit the replay on this as well. So great to have you here, sir. You're looking handsome as always. And Chris Marchese of Silver Seek, Gold Seek, and a few other interesting things, which we'll dig into a little bit. Welcome on in, sir. How are you?
Always great, Chris, when I am with you.
Wow, that's so sweet of you to say that, Chris. Very sweet comment on your part. I believe we may have Rob Kientz joining us. He has not logged in yet. There's a chance that he's explaining the labor report and the flaws in the accounting of that to Janet Yellen and Joe Biden, because certainly it seems like they need some help. So we'll see if Rob is able to join us before the call is done. But with that said, let's dig right in. Or actually, before we do that, one quick note here. Actually, two quick notes. The first is that today's episode is being brought to you by a new sponsor to the show, which is Summa Silver. And some of you saw Galen McNamara about a week or two ago. And wow, the entrepreneurs I've met in my time in silver space, quite an impressive fella. And we'll be having him back on soon to talk more about what they are doing over at Summa Silver. And Chris or Dave, if you have a comment you'd like to share on Summa before we dig in, you're welcome to do so.
Is that the one? Is that in Tonopah?
Yes.
Yeah, I need to take a look at that. BlackRock Silver had a big day yesterday. It was up about 8%. So
it's in good company.
Summa's on my list to look at.
Yeah, well, that's why I like what we have going on here, where I find my strength. I just like looking and learning about the person who's running it. I was quite impressed with Galen, but also you guys having much more technical knowledge. And Dave, I know how you like your storm veins and all that. So we'll look forward to hearing about that, possibly in the Investment Research Dynamics Mining Stock Journal. So thank you, Summa and Galen, for bringing us today's episode. And as we take a quick look at the silver price, wait, no, that's not right. Let me refresh that. It was, it's not down 29 cents. Fear not. Let me pull that one up. We actually had silver up a bit today. We had a labor report. We had Basel III this week. A lot of stuff happening. I've talked about it plenty. So let's turn it right over to you, Dave. What would you say to the people? There seems more than almost any time I remember in the last 10 years, or at least up there, of frustration and panic. Is this ever going to end? Should we just throw in the towel? What would you say, Dave?
Here's the thing. I mean, you gotta put the precious metals market into a long-term perspective. And that, everyone complains, and I complain about the intervention, manipulation. And let's be clear, anyone who denies that the market is interfered with or manipulated by the central banks is either in on the scam themselves or completely ignorant and delusional, because there's official evidence that the market is officially manipulated.
You mean the CFTC commissioner who talked about tamping down the price and how that market structure feature was voted on by Goldman Sachs, JP Morgan, Citadel, and others, or were you referring to something else?
Well, you can go all the way back to declassified letters that were sent back and forth when Henry Kissinger was Secretary of State, just after Nixon closed the gold window, and they were working on developing gold futures, which were rolled out in 1974. And the letters themselves refer specifically to finding something that will divert institutional demand for gold into anything besides physical gold. So that's why gold futures were rolled out. Alan Greenspan was in front of Congress. I forget which particular testimony. I think it was 1996. And Ron Paul was going at him like he always did. And Greenspan, it had to do with Ron Paul asked him, what's the Fed going to do if inflation ticks up, as evidenced by the rising price of gold. And Greenspan said, and this is a paraphrase, well, the Fed stands ready to lease as much gold as it needs to in order to prevent the gold price from going higher. So Paul Volcker, in an interview with I think it's like called Nikkei magazine or something like that. It's a Japanese publication, and he referred to when the dollar was devalued, and this was after they closed the gold window, and the price of gold went from like $100 to $250 very quickly, and he specifically said the mistake we made was not to control the price of gold when we did that. So, there's plenty of official evidence that the market is intervened and manipulated. So, but in terms of, will it ever end? They, meaning the manipulators, have been in a managed retreat ever since the market bottomed in 2000. And actually, I think the actual bottom price might have been early 2001 at $250 an ounce. And if you look at what the price of gold has done and the price of silver has done since early 2001, both have been among the best performing asset classes over this 20-year period. So the best that they're able to do, and this is because of the enormous physical demand for gold coming from the Eastern Hemisphere and other central banks now. There's been several central banks recently that have announced they bought a bunch of gold in the first quarter and during the second quarter this year. And this is physical gold that has to be delivered to these countries' central banks in their own countries, not necessarily kept in London. Some of it's kept in London. So they're basically what you call a managed retreat. And if you just look at it over a 1 year, 2 year, or couple month period, it seems like it's never going to end. But in terms of the big picture, gold and silver are in a multi-decade bull market, and the only thing the manipulation and intervention is going to do is extend the time for which gold and silver will be in that bull market. And I think the bull market ends when we have an eventual reset, and that'll reprice gold and silver, probably not in dollars at that point.
Chris, what do you say to that?
So I agree with it. Everything
Chris
said.
If I may hold you for 1 second there. Celebrity guest entering the room. Here is Rob Kientz. He is logging in. Rob, great to have you here, brother. Welcome on in, and glad to have you talking some silver. How are you today, sir?
Doing well. Thanks for having me on.
Well, it's a pleasure, and we'll let you finish up in the bullpen there while Chris, why don't you take it away and share your comments on what Dave said or anything else?
Okay, so I agree with what Dave said completely. I will correct him. In the FOMC minutes in 96, Greenspan said, should the price of gold rise, we will lease gold in increasing quantities.
Well, he also said that verbally in Congress.
I didn't catch that.
There's a YouTube video.
Oh, and all the statements in the FOMC minutes in the 90s between him and another FOMC member. God, I forgot his name. He was terrible too.
That's all of them, Chris.
So. No, manipulation is never going to end. Ever since gold and silver have been money, they've been manipulated. Not electronically through paper, but the debaser currency, the melted down coins, added copper, then made new ones with a lower gold or silver content. So there was always this manipulation. So that's never going to change. Even when we get a reset. They're going to find another way to try to do it. But you can get discouraged because while you can manipulate it in the short and medium term, you can't in the long term. Like, I mean, look what Dave said, you know, the bull market in precious minerals really began in 2001. And there's been periods of it being just pummeled to death, like 2011, 2012, recently. But if you look at the long-term chart, it's just a steady rise. And I think by mid last year was the best performing, gold was the best performing asset since 2000 over the trailing 2 decades. So yeah, while it's manipulated, it's a pain in the ass, but don't get frustrated. You got to learn how to play it, ideally from both the long and short side. Knowing TA helps a lot. And in terms of Basel III, I think it's a complete joke. So when have you ever known the banks to be in compliance with anything? The government doesn't want the price of gold and silver to rise because it delegitimizes fiat. So they're never going to bust them. I mean, the Fed's a cartelization device of the commercial banks, and the Fed is part of the government, even though what they claim to be private, which is BS. So I don't think Basel III is going to do a damn thing.
I have a response to that. I do think Basel III is doing a lot, but it's not what people thought. So if you look at what people like Alistair McLeod said and Andrew McGuire said, Andrew McGuire came on my channel and said that what it would do was greatly affect the London market. And to be fair, London's not adopting it until January. So to argue those statements, we would have to wait till January to see, because they're not going to adopt it, although it has been adopted by the US and by Europe as of now, as of the end of June. Basel III, the role of it is not to free gold. So I agree with Chris on that. It's not to free gold. It's not to bring about free markets. Basel III is a creation of the bankers who have been the ones actively suppressing the price, and especially the central banking community, aren't going to turn around and enact legislation to let gold trade completely freely. I think what they're doing is they're reorganizing the world currency system. This is something I've talked about in recent videos, and lots of evidence coming from Reuters and other banker mouthpieces like Reuters, telling you what the plan is basically out in the open. And essentially what they're doing is they're using gold to recapitalize the banks. But if you notice, if you read Basel III, they're requiring for gold to be considered a high quality liquid asset class, it has to be hedged in a derivatives market. So they're going to continue to use derivative market. The derivative market is going to continue to be used to control the gold price. I think they're just moving out of the hands of London. I think if you look at what Basel III is designed to do, it's to remove that mechanism. I think it's targeting London, saying you're not the gold center anymore. And if you look at information from Reuters and MarketWatch on who is now going to be basically running the global gold market, it's going to be the BIS. So the BIS is the super central bank, if you will. They're going to control the gold market. They're going to use the OECD to set their standards for the actual gold mining and like regulations around gold conflict trade and the overall mining supply cycle, if you will, the mining. What am I trying to say? The supply from the miners. So essentially, this is what's happening. It's a realignment of the gold market. I do think the gold price is going to increase. I think the silver price will increase, but I think they're still going to control it. The only piece of this I don't know is what's going to happen to the derivatives market. If they're aligning globally under a digitalized currencies with gold at the base of the central banks, what's the realignment going to be in the derivatives market? I'm not sure yet. But the digital currencies are coming. I think they'll be enacted around 2023, 2024. It'd take about 2 years to get them fully in place. They needed to get control of the gold market, though, on a worldwide level, take it out of the hands of the individual nation states in order to implement this digital currency system, because gold is the ultimate counter to the central bank digital currencies. So they had to reorganize gold first. That was part of the reason for Basel III. Now they're rolling out the rails or the networking system for the various sovereign digital currencies. 58 central banks are signed on according to mainstream media, for this IMF and BIS plan to do national digital currencies. And what they're going to give the people is the digital currencies, and then the gold is going to be, the banker's asset and the banker's valuation. That's how they're going to bolster their balance sheets. And I think that's ultimately the plan. So I think Basel III is a major component of what we call the Great Reset. But I don't think what some popular commentators have said about an almost instantaneous repricing of gold is going to occur.
Rob, so let me just get one thing. So for gold now to be considered a tier 1 asset with Basel III, it has to be hedged.
Yeah, well, there's two things according to the Basel regulations, the NSFR, net stable funding ratio. It has to be an allocated form, so that eliminates the London unallocated market completely from that consideration, and there has to be a price hedge. So, in other words, what the central bankers consider the ultimate asset is cash. Why? Because that's the asset that they give the people to trade in. And by cash, I mean either the fiat or moving into the central bank digital currencies. So that's always going to be the ultimate asset because that's their product. That's how they've implemented the system. Therefore, you're always pricing gold according to its cash price in the derivatives market. So they require you to have like a derivatives hedge on. And then if you do those two things, a real allocated gold and a derivatives hedge, then it's considered equal to cash.
And that's a net zero. So it shouldn't cause the price of gold to rise, right?
What could potentially cause the price of gold to rise is the fact that a lot of the unallocated market in London is no longer going to be determining the gold price long term. Now, as to what the new mechanism is, I don't know. I assume the BIS already has plans in place and the IMF have plans in place for controlling the gold price, but I've been digging on that and I haven't found the final solution there. I don't think they've publicly stated, or maybe I've missed, a news release. Maybe it's in there, I just haven't found it. I do think they have a plan. I don't know what it is yet. And that's the last remaining piece of how they're going to control it. But I do think as a result of some of these banks coming out of the London market and unwinding, they're going to have to unwind the OTC market. So that is going to cause, I think, the price of gold to rise. And I think ultimately when the final step of the Great Reset happens, they move into central bank digital currencies, they're going to have to reprice gold because they're going to own most of it and it's going to capitalize their balance sheet. And I don't think we're near that. I think we're probably a couple of years away from them doing that.
Yeah.
Well, Rob, I have a question, if I may.
Mm-hmm.
What if conceivably Basel III wasn't meant to create a surge in the price, but what if it was meant to protect banks or other entities so they could deleverage before a big move were planned, and that way they wouldn't be caught offsides or require massive bailouts, perhaps similar to when Michael Burry got that phone call from Goldman Sachs in The Big Short, and they said, Dr. Burry, we've been reviewing your position. We have some new marks. And he says quite brilliantly, I think what you meant to say is that you have a short position on, you're going to finally mark the thing correctly. And perhaps, like many people pointed out, it was, now I could construct a scenario in where I could see the BIS screwing the commercial banks, but maybe that's less likely. And perhaps there's just a lot that can't be seen just yet, like you point out, which is different to say that something isn't happening because, all right, I get, we all to differing degrees struggle with this recency bias, but do you think that's possible before I add in question 2?
So if you look at who owns the central banks, at least we'll focus on the Fed, it is the commercial banks. So the commercial banks are not getting X'd out of this equation. Essentially, what's happening is if you look at the history of why central banking is here, is to control the money supply. And by controlling the money supply, you can control the sovereign governments, right? And you can control the flow of what happens in politics. And essentially, you can control industry as well because you're giving out all the loans and you're controlling the flow of capital. But what the plan is, and this includes China, by the way, because the IMF has said they're going to move their office to China. The BIS has been signaling they're working with Singapore and China on developing the digital currency system. So what's happened is we're now moving to a global central banking model, which the BIS is more at the forefront of running that. The individual central banks, which are owned by the commercial banks, will participate in that scheme. And they still have individual sovereign currencies. But what the central bank digital currency system is designed to do is to connect all of that together so you can control it all basically in one place. So you're seeing the globalization of the banking sector. And the commercial banks will still take part. They're still going to own, the stock of all the central banks and control the central banks. But they're no longer needed in order they're no longer needed at the sovereign level or the regional market level. Once you globalize this system, they're still going to be involved, but they don't need to take part. So it's just kind of the next stage of the evolution of the fiat currency model. And I think this is what when they created the Federal Reserve, this is what they wanted to do, but they didn't have the technology back at the time, right? They wanted to create a global currency system, but it occurs in stages. And it wasn't until the NSA came out with the paper in 1996 and posted on MIT's bulletin board that what about digital currencies, which I think the NSA is behind Bitcoin personally. And I think they've let the private sector develop their central bank digital currencies. And then when it's ready, they're going to take over, they're going to implement the central bank digital currencies. And so this is sort of the final piece of their puzzle. They will create this global system. But it's not going to look like a global system of people because you're going to have individual central banks and individual digital currencies, but they're all connected together. And the software being developed by JP Morgan and Temasek and DBS is, it's already been announced, is I think it's called Partior. And I have a couple of papers on that my subscribers have been sending me. So there's more to it than I can even explain here. But that system is being developed by JP Morgan and DPS and Temasek is for the purposes of connecting all these digital currencies together. So basically now we can tie the globalization of the gold market, the globalization of the fiat currency markets together.
Dave Kranzler, or go ahead, Chris.
So this kind of sounds like Brentwood's Redux with a lot of different variants in it. Instead of gold, it's still a global
what
monetary
else
system.
could eventually happen? All right, so it's not this week, but I mean, it's like that's where I'm left. Where what else is? I mean, they're hyperinflating the currencies around the globe as we speak. Yesterday, I was on a show and someone pointed out that Lebanon, they're storming their central bank. Actually, reminded me a little bit of the people jumping into in Iran right in 1979, taking over the embassy right before a silver spike then, which was by many of the authors of the books in that era, they said was a big part of that. Now, Dave, I see a look on your face as you've been listening to Auditor Rob talk. I've never seen such focus. In fact, some of your fan club members are even going as far. Dave the Thinker would be a great in a sculpture garden. So you look like you've got something you're mulling over there. Take it away, please.
I put one in my front yard.
I would put a Dave the Thinker in my front yard too. Yeah. Silver, of course. In fact, we have someone making new silver products. We'll add Dave the Thinker to the line, but let's get right to Dave the Thinker. What do you got?
So I haven't heard it all in a narrative the way Rob just laid it out, but I think he's 100% correct. I think the part that was missing, and I have read reference to this from a couple different analysts that I respect. I think Hugo Salinas Price referenced it also. Essentially, the BIS is pivoted toward Russia and China. And in this Basel III plan that's being implemented is heavily influenced by China and Russia's input. And I think it was last week or the week before, an ex-Chinese central banker was put on, the whatever they call the ruling body of the IMF, and I think that's very interesting. And also there was an article out a couple of weeks ago that announced that China is actually beta testing its digital currency in one of its provinces. I don't remember which province. So the way that Rob explained how Basel III fits into the whole scenario, I think he's spot on that. And that's what I was sitting there contemplating, because I think he's right. And I agree with him. And I, as soon as I saw the articles coming out from the various mouthpieces that, gold, Basel III was going to, cause the price of gold to go to the moon, that's when my skepticism antenna went up and I started researching it. And I'm like, no, Basel III is not what people think it is in the Western Hemisphere. And I agree, it's going to, it's unseating London as the nexus of the gold world, because London's become a completely fraudulent derivative unallocated gold market with piggybacked by the even more fraudulent gold and silver market in New York, otherwise known as the COMEX. So, Rob, you should put what you just said in writing, or I'm going to have to re-listen to this and listen to it again, because that was a brilliant explanation of what it is.
Yeah, totally. I didn't look at it that way before.
There's a couple of videos I put out.
I kind of knew some of the various pieces of it, and that it had nothing to do with trying to push the price of gold higher, or it is about smashing the derivative gold market, the unallocated gold market, but it's for the purpose of shifting the control to the BIS under the heavy influence of China and Russia, which explains why they've been accumulating so much physical gold over all these years.
I've always resisted, in Basel III, that China and Russia and India would cooperate with us asshats in the Western world. I mean, it always seemed like China wanted their own currency. They wanted to be the reserve currency, or them.
Well, you know what, though? They never said that. They just said there should be a reserve currency, just not the dollar.
Oh, I know. That's just what I got out of it, how they talk. So.
I do have a couple of videos out on it. The only reason I think I put this together is because I have really great subscribers, part of our research intelligence team that constantly sending this information in from all over the world. And if you kind of see all these pieces from around the world, you get it. And I think the piece that put it together for me was what Dave said when Hugo Salinas Price came out in an article and said Russia and China had threatened the U.S. and the Western system and said, we're going to peg our currencies to gold and go challenge the dollar. And that's why Basel III basically came about, and why it's being enforced, and why why the conflict between the Fed, the European Central Bank, and the London, the LBMA basically came about. A lot of that Ronan covers on his side as well, Bullion Star. So it's just putting the various pieces together. And I think it wasn't clear until recently when some of the articles came out talking about how essentially not only the gold market would change, but some of the digital currencies, were going to come about and be implemented. And then you kind of put the pieces together.
Rob, do you have any idea how they will introduce the digital currencies? Will they just take dollars out of circulation, replace them, or just do it, because everything's with numbers, it's not cash anymore. And like in the case of the US, we're so over indebted. Will they, do like what Mexico did in 95 in the peso crisis, like devalue their currency overnight so their debts are manageable, and then replace it with the digital currency? Any thoughts or ideas?
Yeah, I'll answer that question, but I want to add one more piece. So yes, there is an IMF paper which explains how they'll do it, and a blog posting on the IMF, still available on the IMF's website. So I guess I'll just talk about that. So the MMT people are the same people that are Keynesians. But go farther than Keynes. I think John Maynard Keynes, when he originally wrote his paper, was designing a system that would benefit the bankers, but I don't think he knew how far they were going to take it. I think he was in a lot of ways a patsy for the bankers, and someone that they could hold up and say, look, here's an economist that says we can do this, and then we're going to do it in stages. So you've seen over time a light Keynesianism to almost a full-blown socialist model emerging across the world. And modern monetary theory is basically just a restatement of that. And if you follow what the modern monetary theory people say, and even go back to Silvio Gesell, who wrote in the late 1800s, they needed to get rid of debt. So this idea is about 140 years old. And when you start putting those pieces together, you realize this is all part of the plan. It just happens over time. Silvio Gesell wrote 140 years ago, they need to get rid of debt and implement negative interest rates. Now, back then we didn't have the computers to do it, but he wanted to implement negative interest rates so that you could directly control the capital, and you wouldn't necessarily need the debt to do it. And John Maynard Keynes, and I think it was Irving Fisher, lauded Silvio's work and said, yeah, this is where we need to go. So this idea around negative interest rates has been there for a long time. So then take that idea of negative interest rates and go forward to the IMF paper in 2015. In 2015, IMF wrote a paper about implementing negative interest rates in the banking system. And this is how you would get people out of cash. The studies that they did, and the researchers are very clear on this, is they felt as though for this model to continue to exist, you had to go to negative interest rates, that you would have to get rid of the debt model, and therefore you have to get rid of cash. Because what is cash? It's cash is created through the issuance of debt. So in order to go to the digital currencies and go to negative interest rates and have more direct control of the flow of capital, you have to get rid of debt and fiat currencies. And they said it would take about a generation or so to get people off of them. And they actually have a chart in this paper that states which nations are more heavily dependent on cash and where you would have to focus your efforts. So the US is one, Germany is one, some other European countries are one that more transactions are done in cash. If you look at the Asian nations, they've already moved over to mostly digital transactions, either credit cards or Alipay and WePay in China, or those types of systems. So culturally, it's different. So what the IMF paper did is it laid out a plan to align all the various cultures together through the central bank system to get rid of cash. And they said it would take about 20 to 30 years. And so what it would take also is a crisis of confidence in the fiat currencies. If you look at some of the follow-up blog postings, as the system begins to get overheated and it starts to break down, you have a large-scale economic crisis, the fiat currency system can be blamed. And then they can say, well, in order for policymakers to have greater control, because if you think about it, it's never let a crisis go to waste, right? Rahm Emanuel. So when the fiat crisis comes, and it will, they're going to pull credit at some point. You're going to have a crash in the repo market, and then you're going to have a banking crisis, and you're going to have a fiat money crisis eventually. When that occurs, they're going to say, you know what, we need more control. We need to go to central bank digital currencies. And what they're going to say is they're going to couch it in, look at all the support for Bitcoin and these other currencies. They're wonderful. People support them. So we're going to take that idea and create these central bank digital currencies, right? And what a great idea. And then when they do that, they're going to get rid of the debt-based model. So the debt will either be inflated away or just gotten rid of. And they're going to go to a direct negative interest rate system. And the system is not negative interest rate debt. In the 2019 follow-up blog post, it's negative interest rates in your bank account. So you get money, it gets deposited in the bank account. You put $100 in and you get 95 $95. And those 95 $95 are how you buy goods and services. You do it through Amazon, you do it through wherever, you do a digital transaction, or you have an ID card that you take to the grocery store. And that's what the FedNow system is. The FedNow system being set up in the United States is direct payments to consumers, circumventing basically all the governmental systems in place. So you won't get a rebate check from the IRS, and you won't get like disability distributions to the government. Everything will be deposited directly in the central bank to you in digital format. When that money comes in, they automatically debit out the amount of negative interest rate they want. And in the IMF paper, it said we can go as low as we want. So they're not going to put a limit on it. You could go 40% if you needed to. And if you look at modern monetary theory, what they've said, in order to completely control the monetary system, you need to have two things. You need to have taxes, which allows you to adjust the amount of money aggregate you pull out. But you also need to have a more real-time mechanism in the banking system through negative interest rates to determine how much money flow there is. So if you want to stimulate, you reduce the interest rate, the negative interest rate. If you want to retract, you increase the negative interest rate. So this is the plan. And again, it's in their paper. I'm not making this up. They've written out how they're going to do it. And and you can go to the IMF website and search through there, and the plan's been laid out. Now, 56 central banks, it's been reported by Reuters twice that 56 central banks have signed on to this program explicitly. And, that includes all the players that we've been talking about here. But in order for all that to happen, there's got to be a crisis of confidence in the fiat currency. So whenever we get to the next financial crisis, the fiat currencies will be blamed. We'll have the hyperinflations. It won't just be the dollar, it'll probably be the euro, the pound, and some others.
The funny thing is, digital currencies are fiat too.
They are fiat.
So
but if they control the the issuance and the retraction of digital currencies through the banking system, it's more difficult for that system to collapse because they're controlling the total aggregate money flow through one mechanism rather than having to do pull all these various levers. Right now, they got to pull the debt lever, they got to pull, the currency lever, they got to manipulate the gold market, all that stuff. What they're building is a system which is the control will be centralized in the BIS and IMF, and it'll be much easier for them to control all these money aggregates.
Essentially, you could take it to the political extension of it. Essentially, it's going to shift the global governmental system to totalitarianism.
Yes,
we're almost there now.
That's where we're headed.
Yeah.
I hope I'm not around when that system is fully implemented.
Well, we'll see how it goes. I'm personally wondering what's going to happen with this month's CPI. I wonder if we crack 6% on that, but I just keep thinking, all right, we saw what happened the last two in the transitory. I mean, you almost can extrapolate what they're going to do before it happens. And maybe one of those days will be one of those prints. Although, Rob, first of all, I'd like to say, I guess we know now why you were late. You were apparently solving everything in the entire galaxy. So since you're on a hot streak, you just camp out there behind the 3-point line, and I'm going to feed you a couple here. Here's a little realization. Maybe because I was talking to Rob, I started figuring things out here. According to Silver Institute numbers, which perhaps we can take with a grain of salt, see about 1 billion ounces of supply per year down here. Sound good?
Mm-hmm.
Here, total demand, you have industrial, which photovoltaics is subset. So industrial, photography, jewelry, silverware, and net physical investments. So that's Andy Schechtman and the bullion dealers. So if you take total demand and subtract out net investment, are we in agreement that would give you a proxy of the industrial fabrication, if you include, industrial, photography, jewelry, silverware?
Mm-hmm.
With me so far?
Yeah.
So here in 2020, you have 896 minus 200, so that's about 700 million ounces industrial. 995 minus 185, all right, so that year was 800 or so. 989 minus, it's been even higher than 700. It's been anywhere from 700 to 800 in demand for industrial. The supply is 1 billion. And as I've been thinking about it, while I've been sitting here waiting for silver to implode or the paper market to implode for the last decade, yeah, there's the imbalance. The thing went below the cost of production, but it's like, why hasn't that mattered yet? And it's actually pretty simple. And I think also this provides a framework. I mean, a lot of these numbers maybe we don't have, although could probably extrapolate by asking around, because essentially you have the supply of 1 billion minus the industry, and then whatever's left over is what's there for investment. So in the past 10 years, well, anyone who invested in silver felt like they're getting hit over the head with a shovel. You crush the demand. You would hear people sounding a lot like we've seen this week. This longtime guy, he just threw in a towel, he couldn't take it. But look at what happens last year, where you have 331 go into the trust, another 200. So last year, investment demand was 531. You're in a deficit, and out of left field on a random couple of weeks in. Did you say something, Chris?
ETPs that's paper.
I agree, but at least
unallocated.
Fine, then that's I'm not disputing that, but I mean, then that's, if you're going to count that as paper, then that's further evidence that they're lying with the vaults. But just using the numbers on the face of it, I don't think it's an accident. Last July, silver pops through 20 for the first time in, I think, 7 years, and does it in the span of 4 weeks, because finally you've had, all right, when it was under 200 or 300 or whatever the gap was, the price is lower. But now if you have it over, I mean, they're projecting 252 in bullion demand. Hard to imagine we're only going to be 25% higher than last year based on what I've heard, but hey, we'll see.
You can't buy any, so I could see that, I guess, right?
I mean, but is that where we're at, where now you have, when the price goes through 30, we saw what happened when it gets smashed, Schechtman and the dealers saying the phones are ringing off the hook. That seems to me, it's like maybe we've finally reached or very close to that point where, all right, fine, whatever the number is, if it's 500, 300 or something bigger than the gap, now you're in problem territory where actually, and that's, I guess, for me, what's the biggest difference? Why is this different than 5 years ago or 10 years ago? I think the fact that you have Wall Street silver, that I'm doing a show, Rob, you're doing a show. I mean, Chris and Dave, you guys have been doing this for a while, but there's a ton of people that now know that there's the Ponzi scheme out there, and we don't know when it's going to end, but you can't unknow it. And maybe some people give up, but Rob, is that perhaps a way of isolating what we're really searching for here?
Yeah, so basically, I think you've made the argument that it doesn't take a lot of additional demand basically to bankrupt current supplies, right? And we are in a net silver shortage when you look at the increase in the overall investment demand. I guess that's what you're asking. So,
let me put, just to make sure that it's clear for everyone, with the rate at which people were buying silver last year, let alone before we had Wall Street silver that's popped 120,000 people in a couple of months, and they're sitting there, taking photos of their silver stack, and everyone's trying to outdo each other and make banker memes. That seems to me a little bit of a problem of something. I don't know how that's reversed.
I don't either. There have been what I'll call mouthpieces or mainstream analysts that keep coming on saying that you can't cause a run on the silver market through retail demand or investment demand because there's always stockpiles. You have stockpiles in COMEX. You have this stockpile, that stockpile. First of all, I don't believe the stockpile numbers, but even if they were true, people aren't going to let go of that silver at the current price. The price must rise in order to liquidate whatever free silver there is, whether it's a couple 100 million ounces, a billion ounces, whatever the case may be, and we don't know. But the prices are going to have to rise either way because the pressure that's being put on the silver market is such that current mine supply is not going to be able to meet demand. The Silver Institute had that paper last November that said they expected, silver demand to pop over 1 billion ounces this year, mostly on the back of an increased industrial demand. And that was before Wall Street silver even got started and the silver squeeze got started. So whatever projection anybody's been using for 2021 in silver is not taking into account that retail demand. And so the price has, the physical price has to rise. We've seen that in the retail market. My question is, when does that happen in the industrial market? You have these derivative complexes that are constantly underpricing silver. When do we get to a squeeze of Apple and Tesla and Samsung to where they don't have silver to build their products? How close are we to that? And maybe that's what ultimately breaks the derivative scheme. I don't know. Maybe I'll defer to Dave for that. But I mean, certainly the pressure is there from a demand perspective.
So the reason why I don't think that retail has the ability to affect a squeeze on the market is because retail, for the most part, sources their metal from coin dealers, right?
Mm-hmm.
And so what happens is when the supply gets tight, the mints are put on allocation by the governments. And that's what we've been seeing this year. So essentially, the governments can control to a large degree the supply of silver to retail, and that's why you see the premium blow out like that, because the demand's there for retail and retail is willing to pay a lot more, but that's not the ultimate market price that industrial users are paying. So to me, when mints go on allocation, that's evidence that the global silver supply is tight. So, and the other wild card that we have in here, unless it's changed since the last time I looked into it, we don't really know how much silver gets imported into China. I think there's some sort of industrial import report where they report silver concentrate brought into the country, but we have no idea in terms of actual physical bars how much is going into China. And again, this was a few years ago, but the last time I had researched it, all of the silver that China was producing domestically was going into their solar program. So, that's another, it's just like we don't know how much gold is really being accumulated by the Chinese central bank. All we know is it's a lot more than what's publicly disclosed.
I know they get around that by declaring it either at customs, either monetary or non-monetary for gold. I wonder if that applies to silver as well, because they only have to report one of those categories.
That's right. It's the non-monetary that gets reported. I guess if you had enough high net worth retail people who would go on to the COMEX and stand for delivery, you might be able to create a run that way. But to me, that's really where you expose the COMEX, is if enough people stand, or enough entities stand for delivery in gold and silver, such that the COMEX has to, they visibly default on it.
Well, I mean, what I would think would happen is, like Rob said, it could break the derivatives market. I think the commercial banks are too smart for that. I can't believe I said that, but I do think they are.
Get crazy here, Chris. Come on now.
But all they have to do to let the market clear is allow prices to rise to maybe $35, $40 an ounce, and a ton of supply could come online. We don't know.
Yeah.
I don't know if you see a lot of supply come on at that price.
We don't know.
You sell your silver at 35 or $40 an ounce? I wouldn't. And the mine supply is essentially, for the most part, fixed plus or minus every year, right?
Yeah.
So you're not gonna, the organic, even if the price rises, the organic supply isn't necessarily going to increase. It'll, at a point, it's certainly, if it goes up to $100, you're going to make certain properties that are not economical now, they become economical, but I don't know how much silver you can squeeze.
You probably have a lot more recycling too, like 1 or 200 million ounces plus more a year.
Maybe, I think we went through a lot of the recycling phase in the first decade of this country, of the century.
Because of that.
Remember the cash for gold companies and all that? Where have they gone? They're gone, right?
I know.
Yeah, because
I will still pay cash for gold or silver, FYI. And I'm not.
No, I understand that, but most people who were going to do it have already taken grandma's silver set out of the attic and sold it to cash for gold.
Did you sell your grandma's
lower quality
set,
silver?
I don't have my grandma's silver set. My
you
sister
sold
does.
it?
No, my sister has it, and she's not selling it. It's not for sale.
Okay, that's good to hear. I didn't want to have Rob come over there and check on you, since he seems to be the adult in this circus today. So before we wrap up here, I know some people are saying, why would anybody want to listen to these four guys when you have experts like Warren Buffett and
Jeff Christian,
Jeff Curry and others out there? Although
that former Mint guy, what's his name again?
Ed Moy. Dave, I know you're a big Ed Moy fan.
The health insurance salesman.
Maybe on your Dave the Thinker Silver Garden sculpture, we could put an Ed Moy t-shirt on you.
Maybe we can't.
Here's something I'd like to play just a second of before we wrap up, because at least in my mind, this is kind of where a lot of things began, because this was January 21st when our same guest that you see on our panel here today. We did that call on what's up with the First Majestic short position. And it wasn't too long after that we had First Majestic soaring, and I'll just play a second here.
Know what they're doing in mining stocks.
So Dave, you're saying that it would seemingly be not the smartest thing to short one of the largest silver producers while the Fed is hyperinflating the dollar simultaneously?
I mean, if you like throwing your money away, it's a good idea, right?
Yeah.
Chris, And here, if we look at the chart, that was January 21st, which was a Thursday. Now, Dave, I remember I called you the following Monday because it was interesting. All the mining stocks were down at one point. First Majestic was up 80 cents, which I remember it seemed so weird. I actually called the investor relations guys at First Majestic. I said, was there news or anything? And they hadn't heard anything. He actually said, I don't know, maybe they saw that call or someone saw it. I don't know if that's actually the case, yet nonetheless, about 10 days later, we saw First Majestic really get short squeeze. I think it got up as high as 24 or 25 intraday. But I've actually been wanting to go back and review a bunch of these things because it's been such a fascinating couple of months that I think we will be looking back throughout history on. Although, sadly, I know that means we're getting to the end of today's call. So I'd like to just let each of you guys mention where they can find more of your research so they can stay tuned with the great things you're doing. So Dave of Investment Research Dynamics, could you give us a minute there on what we have on your site?
Well, you see it right there. It's my site.
Well, it's really, I think, not just your financial analysis, but the copywriting skill and the detail with which you market the products and just like make them so desirable with that description. That's how I got hooked myself.
Well, I've got the Mining Stock Journal and the Short Sellers Journal, and the Short Sellers Journal, it's self-explanatory. Had some pretty good calls lately. Roblox being one of them, Penn Gaming being another. I was recommending shorting that one. It was well over 100. So, and that's weekly, and I do, I intro usually with economic analysis of what happened during the week. And then the Mining Stock Journal, it's bi-weekly, every other Thursday. And I have a portfolio of stocks that I research, analyze, recommend. I invest in most of those ideas in my fund. And occasionally I'll throw in stocks that people ask me about that I don't like, and I'll review those. So, and I try to come up with some new ideas. I focus primarily on junior development companies because that's to me, that's the most inefficiently priced part of the mining stock sector. And it's, I make some mistakes occasionally, but if you just have, 1 or 2 home runs a year, it more than makes up for the mistakes, and you'll outperform a portfolio of Newmont and Barrick and all those snoozers. So, well, Dave,
not to put you on the spot here, I'm catching a couple mistakes on the site, if I may be as bold as to say publicly. First, I don't know, we have JP Morgan quote there, but more importantly, what up with these, if you're backing up the truck now?
Well, if you scroll down, see?
I want the silver truck. So we got to change. Well, can we change this image?
The idea is you convert fiat into silver. You convert fiat into metal when you subscribe to my Mining Stock Journal.
Okay, I see. So we got to draw out the secrets a little bit here, but we get there. And Dave, before we finish on your site here, your dear friend Andy Scheckman, he heard about your love of how the Panda is Dave's favorite of all of the gold and silver products. So he only had 200 gold and 200 silver Pandas. Silver Pandas, 200 of them at $5.99 over $5.59. $5.59 over spot.
That's a good price. That's a good price for silver Pandas.
He says it's the best in the country, and you got 200 gold Pandas at $95 over. So I see Dave has already left to go call Miles Franklin. Couldn't even wait.
I think he went to run there.
Show. Okay, so since Dave is on the phone buying Pandas right now, Rob.
No, I don't need to buy. I got enough right there.
Okay. So
That's
you're not going to
cool.
corner the market by
2014?
JP Morgan.
2015.
Off by a year.
It was a good call, though. Good guess.
All righty. Well, thank you, Dave. Appreciate you being here today. And Rob, since you're on fire today, tell folks where they can get more. Where do we go?
Go to goldsilverpros.com. We do have a subscribers newsletter. It's called the Golden Quarterly, which we're about to change into a weekly subscription here. Stay tuned for that in the next couple of weeks. People are asking us for more frequent updates, so we're going to oblige that. We're happy to do that. We also have a free newsletter. If you click on the newsletter icon at the top and just put in your email address, we do send out frequent updates of our content there as well.
All right, Rob. Well, I certainly would recommend that for folks. And Chris, where do they find you?
So you go to Gold Seek and Silver Seek. That's just, I'm the senior financial or mining analyst there, but my own site is goldseeker.com, and it's kind of like what Dave does. But this is a monthly newsletter with weekly updates and an actively managed portfolio, like look over my shoulder service. I use my own money, so you get to see what I do before I do it. And we cater to the conservative investor all the way down to those interested in junior mining stocks. So the portfolio is basically maybe like 20% royalty and streaming, senior mid-tier producers, junior producers, development, and exploration. Or you can sign up for a free email list, which we're not too active on. Anyway, so my background's in security analysis, so we provide pretty in-depth reports for all our portfolio companies and others that we get asked to by subscribers.
Well, I sure appreciate that, Chris, Dave, and Rob. You guys have the site. You've spent your lives studying these things and sharing knowledge in a very important time. And especially today, I was glad we got to do this. I understand how people are feeling out there. And I think this is helpful to hear it from some people who have known it for so long and so well. Also would like to say thank you for Suma Silver, who brought us today's episode, and certainly run by someone, Galen McNamara, I've been quite impressed with. So feel free to go take a look, and maybe we'll see that in some of your investment journals in the near future, gentlemen. But with that said, we're going to wrap up for today. We see silver up a little bit on the day, so smile into the weekend. And last note I might mention is that Sunday night, July 4th, after everybody's done barbecuing, possibly 8 p.m. Eastern, I think it'll be 8 p.m. Eastern, we're having an online silver party with a red hot 4th of July Drain the COMEX Silver Special. Andy Scheckman's got 1,000-ounce silver bars. So Dave, I know you don't want to hear about this coin demand. You want the real thing. So we're going to facilitate that. Got another one of our friends opening up an interactive broker's account so we can drain the COMEX that way as well. And we'll dig into all of that and more. And with that said, appreciate all of you guys. And I will look forward to checking back in with you soon. And for everybody else out there, do hope you all have a wonderful holiday weekend. Thanks for being a part of what we're doing here. And we will see you again soon.